Hi, I'm going to start with a confession. I don't like driving very much. I'm not in love with cars. I think of them as transportation devices. And luckily, I don't have to drive very much every week. I own a 2010 Honda Civic, and it's not going to get oohs and ahs on the street. And I've never owned a Tesla, but I've driven Teslas. I've never felt the urge to value Honda, but I do feel the urge to value Tesla. Now, there are some companies I come back to over and over again, and you might wonder why. There are two reasons. One is they're interesting. They're fun companies to value. It makes valuation much easier when you have an interesting company rather than a boring one. The second is, in some companies, as you value the company, you're hopefully getting insights about business and valuation in general. And Tesla meets both criteria. In fact, I've told people that everything I know about valuing young companies, I've learned in the context of valuing Amazon. And much of what I know about disruptive companies and what they do to sectors, I've learned from valuing Tesla. That said, every time I value Tesla, and this time it's going to be no different, I get more pushback than on any other company I value. For a simple reason. Tesla attracts people who either love it or hate it. So when I value a company, people who love it view me as being too pessimistic about the company, giving it too low a value, and people who hate the company think I'm just giving too high a value. I think I'm in the middle ground, but you know what? It's not a good place to be if you get attacked from both sides. My last valuation of Tesla was almost 13 months ago, November of 2021. Must have been pure coincidence, but I valued it just as it hit its peak. The stock was trading at about $1,200 in pre-stock split, which would be $400 in today's terms, and the market cap was in excess of $1 trillion. Now I'll get to that valuation, but before I do it, I'd like to trace you through how Tesla got to where it is today, because it's been quite an accomplishment. To understand Tesla's how well Tesla has played the automobile business, let's think of a little history in the automobile business. For decades until Tesla came along, this is a business where newcomers had a really tough time getting in. In the much of the last century, there were only 3 automobile companies in the US, GM, Ford, and Chrysler, and every newcomer either failed or was subsumed by one of the existing companies. Even outside the US, if you look at Europe, Japan, even Korea, you have established companies. It's very difficult for outsiders to come in for a couple of reasons. One is it's capital intensive, and people didn't want to invest that much capital to enter the business. The second, and I think this is just as critical, is it's a business with a lot of inertia, distribution system that worked against newcomers coming in. If you get a chance, you should watch the DeLorean movie on Netflix because it gives you a sense of how difficult it is to break into this business. I remember when Tesla came along in 2006, 2007, the other automobile companies looked at it and said, there's no way you're making it. So when Tesla talked about the electric cars, about making electric cars, the traditional auto company said, it's never going to fly. And Tesla's had the last laugh, at least through now. Because in this chart, I've looked at what Tesla has accomplished in terms of operations over the last 12 years. I've gone back all the way to 2010, when the revenues were 117 million. They were a tiny company. They were a money-losing tiny company, burning through cash. And take a look at where they are today. If you count in the most recent earnings report, the 2022 earnings were in excess of $80 billion. Tesla is now a big car company. More critically, it's now a profitable car company. Gross income, operating income, net income. I mean, that's relatively recent, but you can see the company's kind of exploded out of the box. The revenue growth has decreased as the company has scaled up, but the profitability has improved. This is a company that's shown the traditional car makers that they were wrong, but here's its biggest accomplishment. And this is why I think Elon Musk deserves the term visionary. He's changed the entire conversation in the automobile business, right? When he came along, electric cars were an afterthought to most traditional automakers. Today, they're at the center of every traditional automaker's strategy. So that's what the income numbers look like and the revenue numbers look like. Along the way, it's true, Tesla had to raise equity, especially in the early years when they needed to cover their cash burn. They've also been a little too generous with options, especially with one man, Elon Musk, and they've been critiqued on both grounds. You're saying, why should I care as a shareholder? Because it's affecting your share count. So in the next graph, here's what I look at. I look at the share count, and you're right, the share count has quadrupled over the last 12 years. You can take a look at the number of shares outstanding. It's gone from 762 million to 3.1. So you can see the increase in the share count. But here's the better news if you're a Tesla shareholder. The share count increases have started to level off. They're not going up the way they were in the first years of the company, and thank God for that. And net income is starting to grow at a rate faster than the share count. The earnings per share reflect that. So if you look at just the operating and the revenue numbers, clearly the company's been successful so far. In the market, though, its success was even greater. The market capitalization of Tesla started taking off very early, and early on people were puzzled. But by the time you get to 2022, you could see that Tesla is now not just a player in the automobile game; it's one of the lead players. Now, along the way, I've had multiple chances that I've taken advantage of to value the company. In my first valuation of Tesla in 2013, I found the company to be significantly overvalued. But I valued it as a luxury auto company with relatively small reach. Incidentally, the revenues are projected in my 2013 valuation for 2022, so that'll be year 10 in that valuation, was 64 billion. Tesla's actual revenues are 81 billion. So they're higher, but not by orders of magnitude. Underestimated revenues. But along the way, the last 10 years, as I've looked at Tesla, there are three things that I've learned from the company. The first is that I've significantly underestimated Tesla's revenue potential, at least for the early part of its life. I thought it was a luxury auto company, but clearly it's going after a much bigger market. So that's the first change. I think it potentially can be one of the largest automobile companies in the world. Second, initially when I looked at Tesla, I looked at it as a car company. You're saying, so what? I gave it the margins of a car company. Car companies earn 6, 7, 8% margins. That's a healthy margin for an automobile company. And I capped off the margin on that basis. Car companies also require a huge amount of reinvestment. They require plant and equipment, and I made investment assumptions based on those. And in the years since, I've revisited what I thought about Tesla. I used to think an electric car was a car first and electric next. I think I might have misjudged it because I think an electric car is as much electronics product as it is car, with some of the higher margins from electronic products kind of weaving into the business. On the reinvestment phase, in 2019, when Tesla was making cars in tents, you might not remember that it was viewed as a bad story for Tesla. But as I watched them do it, I said, maybe I've misjudged this company because clearly they found a way to make cars without the huge plant, equipment, and reinvestment that traditional car companies have. So higher revenues, better margins, less reinvestment. You can already see why when you make those changes, the value of the company is going to go up. So in June of 2019, I'd already reached that point in looking at Tesla. I value Tesla. And this was right after, remember the episode where Elon Musk had sent out that, I think it was a tweet, funding secured, and all heck broke loose. Lots of bad things were happening around the company, and the stock price had dropped to about $180 per share. I valued Tesla as I had multiple times in the past, and for the first time in my valuation experience with Tesla, I found it to be undervalued. I bought the stock then. I got incredibly lucky then because I hit the stock at its absolute low. And when I bought it, the blog post I wrote about the company was I described it as my corporate teenager. You know what teenagers do, right? They look in the mirror and they ask a question, what can I do today? I have lots of potential, But what can I do today to screw it all up? I said, this is my corporate teenager. It's going to do things that disturb me, that put its potential at risk, but it's got lots of potential. As I said, I timed it right. The stock quadrupled in the next 7 months. In January 2020, I revisited the stock, I revalued it, and I sold it. I thought it was overvalued. Clearly, I got the timing all wrong, because a couple of months after that, COVID hit. And while most of the world suffered because of COVID, Tesla was a beneficiary. Their adaptable, flexible model gave them a way of not just getting through COVID, but gaining market share at the expense of their competitors. Not only the revenues and income reflect that, but the stock price soared. It hit $1,200 by November of 2021, which would be $400 plus in today's share count. And the market cap crossed $1 trillion. And I wanted to value the company. I wanted to see what it was that COVID had done to the company. So this was my November 2021 valuation. And it was not even my base case. It was my best case. I was trying to see if there was any way that I could get to $1,200 per share. I tried. If you get a chance, go back and read the post. I really tried. I gave it revenues that reflected, that of revenues larger than any other automobile company in the world by more than $100 billion. Margins of 16% as they move through time. And reflecting the low risk-free rates and risk premiums then, the discount rate was only about 6%. The value that I got with that combination of high growth, high margins, relatively low reinvestment and low discount rate was about $690 billion for the equity and about $571 per share in share count terms then, which is about $190 in today's share price terms. I said, look, I've tried, but I can't get to 1,200. I think the stock was overvalued. And this was at its absolute peak. Well, 2022 has been quite a trial for the company. It's been a trial for the company. It's been a trial for its founder CEO. It's been a trial for the market. Let's go through each one separately. Let's start with the company. The best way to think about how Tesla navigated its way through the year is to take a look at what its 4 quarterly earnings reports for 2022 contain. In the first one, Tesla beat analyst estimates on revenue growth and margins, but acknowledged COVID-related production problems in its Shanghai plant and looked pretty good still. Second quarter, it reported a slowing of revenue growth to 25%, so it looked like the COVID boost was starting to fade, and a decline in margins that it attributed to inflation and competition for electric vehicle components. In the third quarter of 2022, revenues came in again below analyst estimates, both in dollar value and number of cars, not cares, but cars. Fourth quarter of 2022, report this came out yesterday, it confirmed earlier leaked reports which came out a few weeks earlier that there was going to be slower growth. So there wasn't much of a surprise in that, and decrease in profitability. Again, no surprises there. But because they'd revealed that information a few weeks ago, investors were actually pretty happy with what they saw. But this time, Tesla attributed to supply chain problems. Notice the moving target of problems and how the bad news kept coming through and how numbers came in below expectations for the bulk of the year. I think it's time to take another look at Tesla because of that change. Now, during the course of the year, there was another development that didn't have much to do with the company, but had everything to do with its founder CEO. For as long as I value Tesla, I've said, look, you're not valuing a traditional company. You're valuing a company that is connected at the hip to a personality. Why should that surprise us? We live in a world where personality worship, trumps institution worship. So we worship personalities in politics and entertainment and sports. And why should business be any different? And you're saying, so what? Sometimes personalities can help a company. That's absolutely true. Jack Ma at Alibaba, Elon Musk at Tesla. Elon Musk was the best salesperson that Tesla could ever have asked for. And a couple of years ago, at the peak of Tesla's success, I said, what does Elon bring to Tesla? And I laid out the possibilities that historically he'd been a net positive. He added a premium to value because people said Elon Musk is a genius. He'll think of something to do. In many companies, CEOs fade, they become neutral. And in some companies, CEOs can actually be at discount. So, into 2021, it seemed, at the peak of their success, it seemed no contest that Elon Musk was adding value to the company. The question was how much? Now, 2022, there are questions, not just from people who've always pushed back against Tesla, but from people who've been Tesla believers, Tesla advocates. For the first time, you're at least seeing the question being raised, is Elon Musk potentially a net negative to the company? Some of this, I think, comes from the fact that Elon has that Twitter experiment he's running on the side, and for all the more power to him and on that experiment. But that seems to be taking up a lot of his time. It's a distraction. And the problem with Tesla is there's almost nobody else at the company that you can point to and say that person will step in and fill the void. Elon Musk has so dominated the conversation about Tesla that markets are unsure about, is there anybody else running the company? So I think if there was a big shift in 2022, it was as much on this perception of Elon Musk as potentially a negative force in Tesla's value. Personally, I think he's more net positive than net negative, but it is a debatable point now. It wasn't a couple of years ago. The company's changed. The perception of the CEO might have changed. And finally, the market itself has changed. If you remember a couple of sessions ago in the post that I put up on my blog, I talked about how expected returns on stocks have zoomed in 2022. That's not a good thing. Risk-free rates are higher, equity risk premiums are higher, risk capital has become scarcer. That 6% cost of capital I used in November of 2021, that can't stand up anymore. The median cost of capital for a US company at the start of 2022 was 5.6%. At the start of 2023, it's 9.6%. So as risk capital moves to the sidelines, Tesla is one of its big beneficiaries, you'll expect the cost of capital to be higher. So let me talk about what I did differently in this valuation. To be honest, not that much. I'm still giving Tesla's revenues of $400 billion in 10 years. I still think that's an ambitious number. They're at $83 billion. If they get to $400 billion, they'll have revenues far larger than any other automobile company. And as I said, adding on Tesla electric batteries and solar panels is not going to make enough of a difference to total revenues because those are smaller markets. On the operating margin front, I wrestled with what to do. And here's why. During 2022, Tesla's operating margin kept climbing. Remember, it was before adjustment about 12% in 2021, and with the R&D adjustment, 14.5%. Well, during 2022, Tesla's margins zoomed. 16, 17, 18%. In fact, they got a 19% margin in the first quarter. So at first sight, I said, maybe I need to give them a higher margins. But the last couple of quarters have given me pause, especially what we found out about price cuts coming. If you're going to cut prices and cost pressures are building up in your plants, and these are not temporary, they're going to be here, I don't see how I can push the margin up to 18 or 20%, because I think 16% is already a premium margin, and I'm going to assume that they can maintain it. Which brings me to the cost of capital. I gave Tesla a cost of capital of 10.15%, well above the cost of capital you saw in November. And that's a big shift. In my valuation, that is the biggest shift. If you put those changes together, the value per share that I get, with a $400 billion end revenue, margins of 16%, 10.15% cost of capital, the value I get is about $130 per share. On the day that I valued the company, which was yesterday, before the earnings report came out, stock was trading at $143.51. At least by my estimates, it looks like the company is slightly overvalued, maybe about 10%. And I'll admit, I had lots of assumptions here. And as in my prior valuations of Tesla, I put in distributions for my assumptions on revenue growth and margins and cost of capital. And I got a distribution of value. And you can see that, when you look at the distribution of value, the median value is about 120. The upside here is higher than the downside, but it's not as skewed as it used to be. 10 years ago, when you looked at Tesla's valuation, the right tail was much longer. There was a much greater chance of a 10-bagger, the company doing much. Those days are done. Tesla is a much bigger player. You're not going to get that kind of upside here. But stock looks overvalued on the distributional basis at $143. It falls almost exactly at the 70th percentile. But it's not like November 2021, where the stock price was outside my extremes. The stock is in play. In fact, if you remember, in December 27th, I think, of 2022, the stock hit 109. I'd love to tell you that I jumped in and bought the stock, but I was celebrating Christmas. I wasn't even thinking about Tesla. At 109, the stock would definitely have been undervalued based on my estimates. At 143, it's overvalued. As I said, I did this valuation right after markets closed yesterday. Of course, the earnings release came out. The earnings call happened after the markets closed. And today the stock is up strongly. I'm 157 when I checked it. That would put it at the 80th percentile. But we're still talking about a stock in play. This company is 2 big down days away from being undervalued and 2 big up days away from getting out of the zone. So let's talk about what the action plan is. As I said, the upside is now less than it used to be. So, Tesla is a more mature, larger company than it used to be. My valuation judgment is it's overvalued, but not by an immense amount, and the stock is in play. But let's also draw bigger lessons from the Tesla valuation. The first is the one I mentioned, that when you buy Tesla, you're buying not just a company, but a company attached at the hip to a person. Nothing wrong with it as long as you remember that person is a human being. Human beings come as a package, good stuff and bad stuff. And Elon Musk is a package. You get the entire package. He has enough vision to power the entire S&P 500, but he's easily distracted, does unpredictable things, sometimes eccentric. That's a package that drew you to Tesla. If you're a Tesla buyer 10 years ago, you can't complain about the bad stuff and take just the good stuff. With companies that are driven by personalities, that is the package you're getting. And we're getting that package in spades right now with Tesla. Second, whenever I value a company, I think of about core business lessons. I won't even call them laws, principles. Doesn't mean they apply all the time, but they generally apply at most companies. And here are the 3 basic trade-offs that I think of fundamental business trade-offs. Usually to grow faster, to get a higher growth rate, you got to settle for lower prices. So higher growth usually goes with lower margins. To grow faster, again, you need to reinvest more. You might not like it, but for growth, you need that reinvestment. And finally, growth often takes you to niche markets, riskier markets. So higher growth usually goes with lower margins, higher reinvestment, and more risk. As I said, though, there are companies that are able to break these laws, get at high growth and high margins at the same time. Think of Facebook and Google until about 4 or 5 years ago. They're able to grow with relatively little reinvestment for long periods, and maybe even grow and have little or no risk. Those are the companies that become special companies. For much of its existence, Tesla looked like the kind of company that broke all of these laws and continued to do it. It grew while charging premium prices and getting higher margins. It grew without reinvesting like any other automobile company in the world. It grew and it seemed to have found a way to do well even in bad times like COVID. In 2022, Time caught up with Tesla, just like it does for any other company. Eventually, these trade-offs will kick in at every company. And in my view, 2022 was the year those trade-offs got in. Doesn't make Tesla a bad company, but it does mean that you're coming back to Earth from the stratosphere. And there's a final component that I don't feel particularly happy to talk about, but I think needs to be talked about. We live in a world where politics drives everything. It drives where you shop, Home Depot or Lowe's. It drives where you eat, Chick-fil-A, you can't eat there. It even drives, which sports team you pull for, what quarterback you want to win the Super Bowl. What made us think that this would not come for business? And it has, and investing. And 2022, we saw an experiment run on what happens to people's decision-making when their politics clash with their investing. And this came from Musk's takeover of Twitter. And the world split into people who liked what he was doing at Twitter and disliked what he was doing at Twitter. And we've seen some turnarounds this year. People who used to love Twitter now seem to not like it as a company. And if you push it, turns out it's nothing to do with Tesla. It's got to do with the fact that they don't like Elon Musk's politics. Conversely, there are people who used to not like Tesla, who want to go buy Teslas, and you ask them why. Because they like his politics. It's not healthy, but it is what it is. As human beings, that's how we behave. I would like to believe that I'm in the middle ground, as I said, on Musk, but I might be deluding myself. So that's something to factor in, is figure out a way to keep your politics outside of the valuation, but it's almost impossible to do. Take a look at the spreadsheet with my Tesla valuation. And disagree with me, give it higher revenues if need be. And if you think you ain't on higher margins, just remember though to test your entire story. Don't just play with one variable at a time or disagree on a single dimension. Think about how the package plays out. So if you want to push for higher margins, ask yourself, how will Tesla be able to earn these higher margins if it's aiming to also be able to sell $600 billion worth of cars? I hope you found the session useful. And thank you very much for listening.